getting to a decent term sheet is very important. Now, term sheet is a container. You see here that there are very different term sheets, particularly between debt and equity. In fact, personally, I prefer to call the term sheet in equity not a term sheet, but more like a shareholders agreement. And then you have, of course, a draft shareholders agreement. Because generally speaking, in equity, you don't want terms. You want money and you get an investor. And that together is a set of assets, if you like, that you'd like to discuss. And I think also for a session like this to talk about, you know, exit clauses and what have you, tag along and drag along type of issues is a little bit too technical. That actually refers to the point we made earlier, that when you're looking for investment capital and you are going to look for equity investors, make sure you have a proper advisor. There are a few of those advisors, proper advisors in the room, and maybe at the end of the session we'll go around and see who's doing what. So if you are looking for capital, do ask for those advisors. And I mentioned, this is not a commercial pitch, but I mentioned it, that the Finance Catalyst team that I'm the team leader of does advise companies on renewable energy in Africa on that. Not all, there's a little bit of a selection, but generally speaking, that is what we do too. Debt agreements, and Audrey and I discussed whether to put up a slide with 4 pages of debt conditions, and we thought you guys would be asleep within 5 minutes. So we didn't do that. Debt agreements, as it says, are pretty standardized. That is the list of things that you need to discuss and agree on. But how they look, like, you know, debt service coverage ratio and all kinds of fines and obligations, is completely tuned to the deal that you do. I've done a zillion of term sheets. I think I never ever was able to copy one from a previous deal to the next deal, change a few words and then sign off. It was always, okay, let me rethink, what's the business all about? What is my added value as a debt investor and or as debt provider? How do I think my conditions reflect on the business and on the entrepreneur? And does that come together nicely in a particular term sheet? Debt term sheets are much easier to read, I find, because it's more technical, it's more yes, no, black and white. Equity term sheets are much more about understanding what is meant behind the words. So it's more of a journey that you take, oftentimes with your financial advisor, with the investor. So it's different how they work. Other than a term sheet, that's why we have a presentation. There are concession agreements if you do rural electrification, for example, if you generate power via small hydropower, or if you do wind power. There are power purchasing agreements with your off-taker, which can be the national grid, can be a local community, can be an industrial off-taker if you do waste to energy for a particular sector. Those, all they want to do is to make sure that you sell and they buy, and that you know what it is that you're selling and buying. But from there on, it's completely different again. If you sell solar on a mini grid, you do completely different business than when you get the waste from a slaughterhouse, you sort of recycle it or process it into energy, and you sell it back to the same slaughterhouse. It's completely different business. So there too, you actually need to know, to understand your own business, and then take a financial advisor, or if you're a finance person yourself, take your technical business side from the right side of your brains to the financial side on the left side of your brains, and translate what it is that you want to do. It's very specific, and again, like with the business plan, don't sit and invent it yourself. List what it is you want to see, and then go talk to people. Friends, particularly the ones that don't like you, again, but also financial advisors who can help you to make sure that what you have listed as the terms that you would like to see are indeed appropriate terms. Definitely one of the most sensitive elements in getting to funding. This is not a debt term sheet, this is just a few elements that you would see. The borrower, it says your company. Well, we mentioned earlier, if you are developing a project, will the borrower be the development company, so you and your people developing a particular project to some point, or will it be, say, the separate entity that owns all the assets and that has the power purchase agreement and everything else around it, which is the project company. Both may need debt, particularly the project company will need debt, but they're completely different. So if it says your company, even that is not a simple answer. It's an important question to ask because it's where you start structuring your deal. Structuring the deal means that you apply a sort of capital with a sort of layer of high risk and low risk in the appropriate structure so that you don't pay too much for expensive capital that you don't need, and that you have appropriate capital to grow and take risks if you run into them, which you will. That too is very important at this point. Now, the lender, oftentimes banks, but that's in the general business. If you're in the renewable energy business or clean energy business in Africa, I wonder how many banks, in general banks, are really interested. I know a few, but only a few. Most lending comes from specific vehicles, such as Sunfunder. Some lending is secured by TCX, like companies who do risk mitigation. Some people in the room will know particular investors that are interested in providing debt and not equity because of some risk profile that they have in their own portfolio. It's not said that you go to a bank. It can be a financial institution or a financial investor that is interested in providing debt. Then, of course, how much do you want to get? Well, you could cut that in two pieces. The one part is what you can afford to lend, or to borrow actually, and how much you really need. And that's where the latter part of the last discussion comes into the picture. You have to have an ambition, and you have to see a cash flow that goes into that direction, and you have a realistic plan for the first, say, 2-3 years for which you most likely would like to borrow the money. Generally speaking, you have to show at the end of that period a particular milestone where you demonstrate to the lender that you can repay the money on a decent basis with some margins, that if the business doesn't roll out as you expect, like only 30% or 50% of the proceeds will be coming in, how that affects the repayment of that loan. And 30-50% after a 2-year period, if you're a startup, is not an uncommon thing. Your plans may be, and generally are, too optimistic, but it's hard to tell how much too optimistic they are. So as Audrey said, they will say, well, an investor or a debt provider will say, let's just assume half of what you promised will be realized, and let's see if I can be repaid on that basis. You have to be prepared for that kind of discussions, which are not to express distrust in what you've said, it's just to reflect experience, not so much from your own business, but from many other businesses that is in the framework of thinking of a debt provider. As I mentioned, equity is a different game. It's not so much about a term sheet. It's more about understanding the appreciation of the investor of your business and getting into a conversation with that same investor on what it is that you want to achieve, that he wants or she wants to see. And then whether you call it a term sheet or a shareholder agreement or a draft letter of whatever, that's fine. Depending on how formal the investor is, there will be more formalities and it may be a term sheet. But if you work with an angel investor, and if, for example, your first investment is 3 investors doing $50,000 each, you may not even need a term sheet. You just may need to sit with the investor and agree on how you want to do it, and then you have a deal. It can be that simple, right? Currency, very, very relevant topic. Maybe at some point you can mention a little bit about what you do in terms of currency hedging and how important that is. In Africa, when you attract capital in dollars or euros and your business is rural, meaning in cedis or in Kenyan shillings or what, you do have a currency issue that will affect your business either way. It can be a very technical issue that you have to deal with that may not be in your comfort zone to discuss, but there are companies and advisors that can help you in doing so. And maybe, Per, if I'm finished, you can briefly introduce what it is that you do on that side.
With great pleasure.
Yeah, in a sec, because it'll be just this one. As I said a few times, it's not so much what you see is what you get in the term sheets or in the brochures of your investors. Is to understand your own business, step back from your own bias that you have developed by nature. It's how it works. You become an entrepreneur by biasing and focusing, and try to understand what it is that the investor wants to see, and that's the start of how you develop a term sheet with an equity investor, or how you read a term sheet from a debt provider. So that's probably what I wanted to show you. And while you start thinking about questions and how we do the Q&A, maybe Per, if you want to step here, and we have a microphone somewhere.
Thank you for the opportunity to introduce myself and say a few things then about that very specific topic, which is important. And I was pleased to hear that over the 2 days of the conference, the issue of currency risk was very dominant. It's clearly something that is on people's minds, rightfully so. It's a big risk, but the good news is that there's also plenty of solutions, or at least a couple of solutions out there. And the good news is also that, contrary to commonly held beliefs, the solutions that are available, including ours, and I'll introduce myself and us, are perfectly workable and make a lot of economic and financial sense once you properly understand them. So my name is Per van Zwaay. I'm with the Currency Exchange Fund, or TCX Fund as it is mostly referred to. The fund was set up 10 years ago with a very specific developmental mandate to develop currency derivative markets in countries and currencies where these markets do not exist, which in the case of Africa is the case for most sub-Saharan African countries. There are no hedging markets, maybe in a country like Kenya, Nigeria, certainly South Africa, but even then it's very short term generally. And it is certainly not accessible for businesses, but also many of the lenders, like Sunfunder maybe, would have a hard time getting hedge terms from any of the banks. So TCX was created to fill that void. TCX is a vehicle created by all the major development finance institutions in the world. Familiar names like FMO and DEG and Proparco, African Development Bank, and the list goes on. We work with those lenders, but we also work with indirectly with impact lenders like Global Partnerships, Sunfunder, not at this very moment, but through our intermediary MFX, we will be working with them also. So most of the lenders that are active in this, better like that? Lower still? So most of the lenders that operate in this industry will have access to TCX directly or through an intermediary like MFX, but that's the most important thing for you to know is that lenders typically have access to TCX. Lenders therefore can lend in exotic countries, currencies. We refer to these currencies as exotic, but they can lend in Kenyan shilling and Tanzanian shilling and Rwandan franc, these other currencies. So, point being that if you are a mini business or an off-grid business and you're generating local currency revenues, whilst you're equity funded, hedging may not be, you should be thinking about it, but you may not choose to hedge yourself, which is perfectly sensible in most cases. But once you start thinking about debt funding, when you're talking to a lender who expects to be repaid in time, and you're talking to external lenders who are not in the country itself, but to borrowers, offshore, international lenders, they will either, so if you borrow from them in dollars, you're exposed to exchange rate risk, and that is extremely risky and, generally speaking, a very just not a sensible thing to do. Just wanted to say that if you are faced with a term sheet and one term sheet offers you a dollar loan, and in that same term sheet you're offered an alternative in local currency, because you've discussed the issue with your lender, and your lender confirms that he can offer you a local currency loan because he has access to a hedge fund like TCX, you will probably see, and this is the perennial discussion, there's going to be a big difference in interest rates between the dollar interest rate and the local currency interest rate. I just want to say two big myths and two big misperceptions and two areas of serious confusion when it comes to hedging or the choice between dollar funding and local currency funding. Confusion one is that when you look at that term sheet and you see 5% in dollars and 15% in local currency, the immediate thought is that the local currency alternative is 10% more expensive, much more expensive. That is, generally speaking, completely false and a big mistake. Because the currency you operate in might depreciate, or you will assume that it's going to appreciate at a certain pace, that immediately erodes that difference between the dollar and the local currency alternative. And if you then add in other factors that your business is now completely de-risked, you're not exposed to currency risk, you have all sorts of spin-off benefits, much less managerial stress, the ability to focus on growing your business, not being exposed to daily volatility, non-predictability of cash flows, volatility in your P&L. All these things are immediately removed. They're off the table. You now know for the duration of your funding, whether it's 2 or 3 years, you know precisely what your cash flows are going to be. You're going to precisely what your P&L is going to be as far as your debt is concerned. So, and you're not exposed to currency shocks. And look at all of the countries around us in sub-Saharan Africa. Unfortunately, for all sorts of reasons, these currencies continue to be and will continue to be extremely volatile. So let not be, never be misled by the observation that let's say the shilling, Tanzanian shilling, for the last 2 years has been relatively stable. The likelihood of it being not so stable in the near future is extremely high. And if you are a business or a startup business, it is just completely nonsensical to expose yourself to currency volatility if you have the option to hedge yourself. So, in real economic terms, and we're going to have that discussion hopefully with people who are at that stage of raising debt. In real economic terms, I can make the case to most of you that the cost of hedging is, in many cases, zero, literally zero. There is no financial cost. There's a big mistake, a lot of misperception around that. So don't be misguided. Don't think that hedging or local currency is more expensive than dollars. It's very often precisely the contrary, and the dollar option can ruin your business. So always hedge. You should always hedge, and the option is out there. So that's myth number one.
If I may quickly ask, if I'm a startup in solar and I need $200,000 in debt, maybe a little bit in equity, that's separate. Is that big enough to be relevant for you, and would the instrument work? And if it is, how do I find you? And I can go to your website, of course, but you don't have a local office, do you?
No,
that's not how it works.
Well, that's a great question, because we've heard a number of people also say over the last couple of days, raising debt or talking about debt, and then saying, but we are too small to hedge, it's not economic, wouldn't make any sense. There's no ground for that, to say that. Because in most cases, well in all cases, the lender will do the hedging for you. So if you're a small business and you're going to raise $200,000 with one of the impact lenders, that lender will do the hedge for you. So he can just give you $200,000 denominate it in whatever local currency it is, shillings or franc, and he will do the hedge. And we ourselves, when we do direct transactions, it's usually larger volumes, but we have a partner, MFX Solutions. You'll hear that name if you start looking at hedging. We are extremely interwoven organizations. We are the hedge provider. We take the currency risk. MFX Solutions has been set up to be an intermediary between us and smaller institutions. They offer certain benefits relate to collateral and the way the structure is set up, but they will cater to smaller volumes. So that your loan is small is never a reason not to hedge. I would say precisely the contrary. The fact that you're a small business and raising a small amount of funding, you're entering into the realm of debt. You're clearly at a very vulnerable stage. Precisely at that moment, you should always hedge.
And talk about moment. Is this something you address? I'm the ignorant lender, so I like the business that I want to invest in. I don't know about hedging. I have a concern. Me as an entrepreneur, would I say, hey, let's talk about hedging, say during our first meeting, so that the investor can, if you like, reduce the risk that he perceives in the deal? Or should I make my investor comfortable with the deal and say, well, you know, by the way, we do need to do some hedging, go and call per. What stage do you?
It's an interesting. There's a bit of a. If you're a sly negotiator, what you could do is first
They're all sly negotiators.
negotiate a loan and maybe sort of leave it in the middle, whether it's dollars or local currency, and if there's an interest rate price for that loan on the table for the dollar loan, if you then subsequently say, well, but I think I'm going to hedge and I'm going to make you take out the hedge lender, substantially de-risking my business, would you then be willing to reduce the credit margin? So there's a bit of negotiating in there, but I would say, yeah, I don't know, it depends on the lender. I would be upfront, and as Audrey and yourself were saying earlier, you know, just be open and transparent about when and what you want to do and how you want to achieve it. So don't want to take too much time, but I want to refer to the second big myth. Most businesses require dollars because they need to purchase equipment offshore, internationally, in dollars. And we very often hear, so why would I borrow in local currency? I need dollars. That's a big, how do you say? I exhausted the first one. So it's a mistake. The currency in which you denominate your debt is only driven and determined by the currency of your revenues or your assets. If you would borrow locally, so you're a Tanzanian shilling mini grid and you're generating Tanzanian shillings, and you need debt, and you go to a local bank, which is of course in a way the ideal thing, that you go to a local bank and borrow shillings. Even in that case, what you could do is borrow shillings from the local bank. Subsequently, so you take out a 3-year loan in shillings, you have physical shillings, and you buy dollars and make your equipment purchases, but your debt is still in shilling, right? So you buy dollars, and if you need yen, you buy yen. But it's also the same if you borrow from Sunfunder. If you agree that they should be lending to you in shillings, because that's the better and really the only alternative, the only right choice, what they will do, they will provide a loan denominated in Tanzanian shillings. It is now a Tanzanian shilling asset for them and a Tanzanian shilling liability for the business. At the same time, so that the currency risk now sits with the lender. At the same time, they will enter into a derivative with us, transferring the exchange rate risk to us. But the currency in which they disburse is still dollars. So they will, if you denominate the loan in shillings, you can subsequently disburse the loan in dollars or in.
So the disbursement at the time of the loan at the time of disbursement will be then transferred into shillings.
No, so the Sunfunder or the lender will transfer dollars to whatever bank account the borrower designates. Can be a bank account in Tanzania, so he receives dollars here and then spend the dollars here, or keep the dollars offshore and send them directly to China where they have to go to. It's just that the loan agreement, this 3-year loan that you now have received, will say that your repayment obligation is not $1 million, no, it will say it's a billion shillings. And when 3 years later the loan has to be repaid, it's still 1 billion shillings that must be repaid.
Regardless of the dollar.
Regardless of the exchange rate, but the lender wants to receive dollars back. And the amount of dollars that has to be repaid is then calculated by applying the exchange rate at that point in time. So if the exchange rate has decreased, the shilling is worth much less, that same billion shillings that needs to be repaid is going to equate to much fewer dollars. So at disbursement, the borrower received $1 million. When the loan has to be repaid 3 years later, he must repay in dollars, but it might only be $500,000 now. And that loss is then compensated. The loss that the lender suffers is compensated for by us. So the point being,
Assuming you also make profits.
well, there's an interest rate, of course,
Uh-huh.
that then compensates us for that
Ah,
difference. So our model, any hedge provider, it's just the flip side for the borrower. If a borrower chooses between dollars and local currency, his choice is basically between being exposed to risk but paying a lower interest rate, or being perfectly hedged, no risk, and pay a higher interest rate. For us, it's the flip side to that. Our model is to receive the higher interest rate and constantly be exposed to the risk. That's
Makes perfect sense. Yeah.
So two things about borrowing dollars or borrowing local currency, if you have the choice, because most prudent lenders will probably require that you borrow in local currency, or if they don't require that you borrow in local currency, they will make sure that they are de-risked by ensuring that there's a lot of equity in the business, which in itself has its cost. So that's another thing. There are lots of hidden costs by being remaining unhedged.
How would currency exchange, risk mitigation apply to your business, and any questions about that? Well, Per, either you have... there's a question.
Thanks. Hi, my name is Ryan. I'm from basically a product manufacturing background company called Plug the Sun. If you only make 30% margin, for example, and you've got to pay, say, 15% to debt or equity, whatever, in South Africa, the repayment on a loan is much higher. So you were talking about if I borrow dollars or if I borrow rands, for example. If I borrow rands, it's going to be about 15%, for argument's sake, 10%. If I borrow dollars or euros or whatever, the loan repayment's only 6%, 5%, 4%, whatever. I don't understand why I wouldn't borrow, a currency fluctuation and risk aside. Why wouldn't I borrow at 5%? Why would I borrow local currency basically at, say, 15% or 10% instead of 5%? I don't understand that. So, assuming that currency doesn't fluctuate, the rand remains at, say, 14 to the dollar, we hedge or whatever, so there's no risk in it. Why wouldn't I borrow at 5% instead of 15%? I'm not getting it.
Sure. If your assumption is that the rand will remain constant to the dollar, and you are confident that that will be the case for the duration of the debt that you plan to take out, then by all means you should not hedge if you're pretty firm in your belief. And if your business can absorb an alternative scenario. But look, the empirical evidence in a 10% per annum depreciation is nothing in this environment. I mean, if you look at the Tanzanian shilling over the last 3 years, we're looking at average depreciations of 20%. Zambia is, of course, I mean, it's an extreme example, but the Zambian kwacha depreciated by 80% in 2015. The currencies don't depreciate in this environment by 5% or 6% per annum. They do. The Rwandan franc has been very stable, very reliable, and it's going to deteriorate. It will start sliding for all sorts of reasons, I'm pretty sure. But average annual depreciations of currencies like the Kenyan shilling and Tanzanian shilling and the franc, and yeah, sometimes you have a few stable years. The Ghanaian cedi, we're talking about 20, 30, 40% is nothing extreme. So if you have the choice between a dollar loan of 5% and a local currency loan of 15%, yeah, you could think my debt.
And sorry to interrupt you, we're only making, say, 30% or 20% margin, so...
Yes, but exactly because you're making a small margin, you should not take that risk. If your business cannot afford a 10% higher interest rate, it's certainly not going to be able to afford a 10% or 20% depreciation. What I'm saying is that if you choose the dollar option at 5%, if you're doing it in Tanzania, for instance, you must assume, in your base case, you're going to assume a certain level of depreciation. And you're not going to assume 2%. If you make a realistic assumption about exchange rate depreciation, you're probably going to assume 7%. So immediately you know that the difference is not 10%. The difference between the two options is, in your base case scenario, which is probably conservative or aggressive, is only 3%. So you're in expectation, the local currency option is 3% more expensive per annum. If you take the dollars, you must add the cost of depreciation. So it's not 5, it's 12%.
So then typically do investors lend in local currency? Is that what you're saying? Is that what do they do? What do most investors lend in?
Say again?
What do most investors lend in? Is it local currency or is it foreign currency?
That depends on the lender that you're talking about. I mean, if it's a local bank, of course it's in rands. Okay, if it's an offshore investor, it depends. Some have their funds based here, somewhere in Africa. Still then it can be dollars or local currency. Really, our mix, yeah. There's no rule for that as far as I know. Yeah, depends. Okay.
So,
Thanks. Thank you.
So yeah, I just want to finish that point. So in expectation, depending on your currency depreciation scenarios, you're going to assume that the local currency alternative is maybe 2 or 3% higher, for instance. That is, but then you have to think what you get in return for that 2%. In return for that 2%, you get predictability and stability instead of total volatility, and potentially currency shocks that can wipe out your business. And I can refer you to many examples also in this industry that have not survived currency shocks. It's just it's not sensible to be unhedged in this business.
Thank you.